So let me differentiate between FII and FDI. FII is foreign institutional investors. That's a fickle thing. It comes in, goes out, depending on whether it is profitable to stay or profitable to exit. Now, when the markets are high priced, when I say markets, I don't mean physical markets, I mean share market. Capital market is trading at very high multiples. Obviously, people will, FIIs will say, look, will I make much more money from there on, or will I not have much more money earnings? So obviously, there's a feeling that there may not be that much money and that the fluctuations may be there, but the overall secular trend this current year for the stock market is not going to be high because they're already high, the multiples. They were hoping that this Adani debacle will bring the capital market down to a PE multiple of 16 or 17, and they would have rushed in. But that's not happened. Just went a shade below what it was. At the same time, if they can find that there is greater stability in the US and the US policies are allowing increasing interest rates, then they would rather put a bit more of the allocation to debt in the US, which is extremely safe, than equity. See, why have all these people rushed into India or any other developing market, or EMs as they call them, is because the ratio between debt and equity investments in the US on an average shifted towards equity because debt rates were very low, interest rates are low. Now when interest rates are going up, they have less money to allocate to equities, and if they can find adequate returns by investing in equity in the US or certain other developed markets, why would they go? They won't have enough surplus to go and put into emerging markets. So a pullout from India is not because Indian economy is bad. It's not because the stocks are not good. They're high priced relative to the kind of risk weighted rewards in the US equity. If the US equity allocation had not reduced, the allocation between debt and equity had not reduced, then there would have been surplus money beyond what they could have invested in the developed markets, and that would have flowed into India, even if the price earning multiple was like 21. Today it's a little below 21. But in spite of that, it's not coming because they go safe haven in the US. When you multiply risk factor with the return, that's looking better than they get here. And our currency has been depreciating, so in dollars, the return comes down further. So it's a combination of this which makes them go out. But on the other hand, if you look at FDI, this is a good moment for foreign direct investment in India because India is, first of all, a large market. Indian economy is recovering and growing fast, so the buying power, consuming power has gone up. And after all, Indian GDP is about 60 or 70%, depending on which year you take, in that ballpark out of the total GDP of the country, consumption. So if the GDP is going up, consumption is going up, it's a good market. So there is a reason why you should serve the Indian market. If there are raw materials which are used from India for manufacturing, all the better to manufacture in India. If the government policies are favoring manufacturing, even more reason for FDIs to go up, which is the case today. There's PLI schemes and so on and so forth. And in any case, the world is looking for an alternative to China. It could be Vietnam, it could be Malaysia, it could be Indonesia, it could be India. So India will get its island. So we will get a share. So from that point of view, if we look at it, FDI will go up. FII will fluctuate. As I said, that's fickle money. FDI is long term. People think, evaluate, analyze and say, okay, I'm putting money in that country for this following reasons. Therefore, FDI will go up.